Unless you've all been living under a rock, you will be aware of what's been happening recently. As of Friday, March 10th, around 12 p.m. ish, we received news about the collapse of Silicon Valley Bank, right? And I want to dissect what has happened recently. So, Silicon Valley Bank is basically one of the largest banks in the country, right, in the United States. It is actually the 16th largest bank in the country, and it holds up to $210 billion in assets. The reason it's called Silicon Valley, you can guess it, is because it provides the funding for a lot of new tech startups. As one of the most important banks in the tech industry, it is quite influential at the time of, if you want to start any startup in the United States, right? So starting off from March 10th, let me take you through kind of like a timeline of events of what's been happening. I want to give a fair warning. I'm recording this on Saturday, March 11th, and this situation is very fast moving. So a lot of the information I provide today might be already out of date by the time I post this video. So starting off, first bit of news that you see, this is from Unusual Whales, which is a financial journalist outlet. But they're an independent financial journalist outlet. They do amazing work. They posted that Silicon Valley Bank has collapsed, the largest bank since 2008. If you remember, 2008 was the financial crisis. Silicon Valley was the 16th largest bank in the United States, holding $210 billion in assets. There's a reason why he says was, and I'll tell you more about it. There's an origin, right? This didn't come out of the blue. There are a myriad of reasons why the bank collapsed. 3 years ago, roughly around the time, I think around 2023, so 2020, during the Trump administration as a response to COVID, a lot of banks requested some regulations to be tamped down. Before 2020, there were regulations that made a certain amount of banks eligible for stringent regulatory requirements, right? You had to keep a certain amount of assets in your bank. If you're a highly regulated bank, kind of like JP Morgan Chase and etc., you have to keep a certain amount of liquid assets that are comparable to the amount of deposits that you have in your account. So if you have, for simplicity's sake, $10,000 of deposits in your bank, you need to have an equivalent amount of almost or more than $10,000 of assets available. This was only available or only required of banks that had an X amount of assets and above, right? I believe that the threshold was pretty low, around the $1 billion mark, right? That would mean that most banks, including not only from the higher up banks like the big banks, but also the regional banks, were to be required to meet that regulatory threshold, right? They would be required to have equal amount of deposits and equal amount of money or liquidity in your bank, right? That being said, back in 2020, the chief or the president of the SVB or Silicon Valley Bank requested or lobbied Congress. This is per the lever. It's an independent outlet. Lobbied them to increase that threshold, right? To make the amount of assets inside a bank larger, to make the minimum larger, in order for them to not qualify for that regulation. In other words, if you increase the amount of assets that a bank needs to have in order for them to fall under that regulation, that means SVB can get away with doing a lot of riskier investments that would escape regulatory scrutiny. What are those risky investments? Well, they basically, SVB Bank lends out that their primary source of business is not necessarily individual deposits, right? Not from you and me, common retail investors. It's generally from more big money investors. So primarily like startups and all of that, right? The reason a lot of these startups went to Silicon Valley Bank to get their initial financial run, right, is because they made it a lot easier for them to get that money. That they were willing to approve when other banks, they were willing to approve loans when other banks were not willing to do so, right? By other banks, I mean like larger institutions, right? But in the case of SVB, they only had one requirement. You needed to have, in order for them, you as a startup to get a big loan, like a $50 million loan and whatnot, you needed to have assets deposited, a large amount of assets deposited into their bank. You see the problem here. That's one issue. The other issue is that banks generally don't have enough liquid assets to meet their deposits, right? So they need to find a way to make those two meet, right? So what they do is that whatever money you deposit, they invest into these quote unquote safer assets, right? But in this case, that wasn't the case. Like SVB was doing what Lehman Brothers did in 2008, which was to invest in mortgage-backed securities, which are essentially basket of IOUs from regular mortgages that you and I can get on a regular basis, right? In addition to that, they invested in bonds that had a longer rate of maturity. So they invested in bonds that mature or are due by a time frame of 5 to 10 years. In the cases of SVB, it was 10 years. So the reason why that's risky is because those are subjected to market volatility. So let's say you buy a bond. The bond will give you a yield of 5%, but you need to hold it for 10 years, right? But if all of a sudden the price of that bond drops, your investment is not profitable, right? If you sell it right now, or if you sell your bond right now, your investment will not earn the 5%. You will actually lose on that investment. That investment is worth it if you don't need that money within the next 10 years, right? But because interest rates have gone up, they all of a sudden that needed that money far quicker than usual, right? And this was due to a couple things. What happened leading until Friday was that the CEO of the company sold off up to $2 million just out of the blue. Obviously, those public filings, those are filings that are public. The public can see them, obviously on a lagging basis, but they can see them. This was reported, and once it was reported, the stock fell 60%. When that happened, regular customers thought, okay, my money is not going to be solvent in that bank, so I need to take the money away. And in fact, you saw that. You saw a lot of people taking away their money from the bank. That made it harder for the bank to have money deposits in the bank. That lowered the amount of deposits in the bank, and it made them liable for those deposits. Because remember, they had more deposits made than they had liquid assets to cover those deposits. Therefore, they were forced to try and sell bonds, right? But if they sold those bonds, they would be at a loss. So it was like a financial death spiral for the bank itself. And you had a lot of revelatory information come up after the collapse or leading up to the collapse. One of them is that you have, and Unusual Whales reported this, Joseph Gentle. He was the chief financial officer in Silicon Valley Bank, but he joined the firm in 2007 after the Lehman Brothers collapse. He was part of Lehman Brothers, right? He served as a CFO under Lehman Brothers, and you know what happened under the collapse. Now he was working under Silicon Valley Bank. This guy, of course, sold his assets and left the company as at the time of this recording. That's another thing, right? You have lawmakers succumbing to almost legalized bribery, which is lobbying, and reducing the amount of regulations on the bank, but also architects of the previous financial crisis leading the bank, right? Leading up to what? Selling of SVB, SIVB stock by the CEO, $3.5 million worth of stock in the 2 weeks before the collapse of the bank. That's why the bank's stock value went below for by 60%, right? Latest bits of news. After all this collapse happened, what happens? The regulatory body that's in charge of making sure that these things don't happen, right? The Federal Deposit Insurance Corporation took over the bank. This was as of late afternoon on Friday, March 10th. The FDIC creates an insurance deposit, a deposit insurance national bank of Santa Clara to protect insured depositors of Silicon Valley Bank, Santa Clara, California. So local regulators, in conjunction with the FDIC, took control of the bank. They are guaranteeing depositors who had less than $250,000, anything below $250,000 is insured, which means by Monday, all those depositors will receive those funds, right? But anything above that threshold is not covered by the FDIC, right? So that means that if you're not covered by the FDIC, right, whatever money you don't have covered will basically be at a loss, right? And it just so happens that around 95%, and this is per Bloomberg, 95% of those deposits are uninsured, right? And where does that money go? That money goes to payroll of employees. That money goes to investments of a company. That money goes to the cash flow of the company. But primarily, looks like it, the most toxic fact of it is that it goes to payroll, right? Unusual Whales reported that many of the companies that were exposed to, like there were a lot of companies that were exposed to SVP were in the tech industry, of course, were in the startup market. It is estimated, according to Unusual Whales, that around 50% of all U.S. startups will be in some way affected by this. Just think about this for a second. 40% of the U.S. economy is governed by tech. So if 50% of all startups are affected by this, and a lot of the money that they have in the bank is payroll, this is what contagion means, right? This is what rippling effect, domino effect means, right? And there are big, notable names. You have crypto exchange BlockFi. You have the entertainment company Roku, among others, right? There's a whole list of companies, and I can name them for you right here. Roblox, a popular gaming company, they have a ton of employees that have been laid off. But if all of a sudden by Monday you can't immediately pay your employees, right? You're having employees there that are unpaid. Not only are these all of a sudden millions of employees, we're not talking about thousands, we're talking about millions of employees that are all of a sudden unpaid. This could have a cascading effect. Not to mention the other risk factors that are involved with this, right? If one company collapses, right, it creates a psychological effect in the trust that regular depositors have in the system, right? One bank collapse, it's a regional bank that collapses. All of a sudden, you realize that you have money in a regional bank. What makes you think you're not going to be terrified of the prospects of you losing your money if you have that money invested in a regional bank, right? So a lot of the fear involved with this is not so much that these tech startups will collapse, right? A lot of them, like the percentage of tech startups that collapse is 95%, right? That's the range. It is thought that this will precipitate a much larger economic crisis if it is not contained, right? And Bill Ackman was quoted as saying is that if we don't do something, or the federal government, that is the Treasury Department of the United States, doesn't do something to contain this before Monday being the opening of the stock market, you will not only have a stock market crash, but you also will have a situation, which is far more important in my opinion, of large amounts, millions of employees not being able to get payroll. This is catastrophic. That's why this is like being compared or akin to the 2008 financial crisis. So according to like I said before, unusual whales breaking. Nearly half of all U.S. venture capital backed startups were involved in the Silicon Valley Bank. What this means is that they had deposits in the bank. So if the bank collapses and those deposits fall above the 250,000 threshold, all of a sudden they will be affected. It's not only them, also stable coin, quote unquote. The actual coins are being affected as well because they had a lot of their assets in SVB. And this is happening across the board. We're finding more and more banks that were affected. First Republic Bank being one of them. I'm based out of Boston. They have a lot of their headquarters over here. They have a long line waiting of customers waiting to take out their money off the bank. I don't know about you, but I think that's pretty terrifying, right? Another bit of important news was that the federal chairmen, so the ones in charge of the federal bank, are meeting on Monday in an emergency meeting to discuss the collapse. In my opinion, they should meet right now, but that's up to them. And the last bit of news as of March 11, Saturday, March 11, 3:14 p.m. This is like changing by the hour, is that the SVB's new owner, the FDIC, so obviously the federal government regulatory body, which now obviously owns the bank. So the bank in its original shape does not exist. It's owned by the FDIC. Is giving workers 45 days of employment. So what they've done is they've taken sufficient assets that belong to Silicon Valley Bank, and they have converted into liquid assets. That means money. They've converted those assets into liquid assets, and they're going to use them to pay for payroll for the next 45 days, right? So all these companies that had money tied up in the bank, they will be able to use have some of that money back, enough to pay for their employees to have payroll for 45 days. This is like an evolving situation, right? This is a band-aid. This is by no means solving the crisis, right? And we'll see in the next couple of days what materializes out of this. I would say that we will see some form of buyout. I think the first option will be find another bank to buy off this bank, another financial institution to buy off this financial institution, or a possible tech giant to buy it and create another tech firm, like a fintech firm. If not, you will probably require a similar situation as 2008, where you need to have the federal government step in and either nationalize the bank, which is unlikely in the current political state, or bailout in that bank, which is also highly unlikely. I would say the most likely scenario will be that the FDIC will send out the $250,000 checks to all of those who are insured. That's the first thing that will happen, probably before Monday. The next thing that will happen will probably be that they will keep on selling assets of the bank in order to make up for the deposits that were there and were not insured through special dividends like they just did just now. But I think the most optimistic scenario, if that were to happen, is that about this, and this is stretching it, about 50% of the assets that were uninsured will be able to be provided to the depositors. And that is also another band-aid that is not necessarily staving off contagion. So thank you so much for watching. Please leave a like, subscribe to the channel, share this video with your friends, and I'll see you all in the next one. Bye-bye.